And I call the Honourable Member for Bowman.
Look, thanks, Deputy Speaker, and far from being a day of shame, today really is a day to recognise the thousands of financial planners around Australia who do an extraordinary job protecting and growing the investments of Australians, and the millions, obviously, of Australian clients of financial planners, all of whom are satisfied with the services they receive. I mean, if you listen to the debate in this chamber, you'd really get a sense, if you're listening to this majoring in the minors by the previous speaker, the member for Oxley, who never really saw a parliamentary speaking slot that he couldn't fill. But in essence, what he delivered could well have been done in 3 minutes rather than 30. I recognise that the member for Oxley spent a lot of time while in government working very, very hard in an inquiry, examining this matter. And the Storm financial collapse and other similar stories are of enormous concern to everyone. But for professional groups who are often given trust and reliance by citizens, we do need to make sure the services that are provided are exemplary. We live in a nation where we can expect that. But we also need to be mindful of the limits of government intervention. And to give you a well-worn analogy, when an eye surgeon is sitting there talking to a patient, I mean, precisely how many pieces of paper being filled out and signed will protect a patient from an adverse outcome. I mean, in the end, we are reliant on expertise, on goodwill and loyalty to our customers. In the end, we know that in 99% of those arrangements that exists. So the final question we can just consider here is really, what do we do in the 1% where we see us straying from that trusting and productive relationship? So never do we want to sully the other 99% of relationships when we as government stumble into the tiny financial planning practices around this nation and tell people how to do their job. That's right. We tell people how to do their job. And there's a reasonable balance there between ensuring a high level of service provision and still being able to ensure that we can provide low-cost advice to people who need it most. I mean, Deputy Speaker, we are not in this debate considering sophisticated investors who earn over $250,000 a year and are able to indulge in some very, very elaborate and sophisticated financial instruments and schemes. I mean, we are talking about allowing more low-income people, for instance, in very small micro businesses who don't have anyone paying them any superannuation whatsoever, to contemplate an appropriate asset mix for their future. And what we're trying to do is open the door to those people so that they get some, not no, financial advice. And I know that the focus post-storm has been on irresponsible giving of advice. But as I've said before, it's really incumbent upon us here in this chamber to just understand how complex our governmental interference can be in that relationship. I mean, in the end, government can't be sitting in every practice. Government cannot be holding the hand of every consumer. Government must give citizenry an opportunity to complain, protest, to access information and have it transparently provided. And all of that rests within this legislation. The changes that we are making here basically looks at reducing compliance cost and the regulatory burden that in the end makes almost no difference to the information that is provided to customers and almost no material difference in their decision-making around financial advice. And I mean, that's the core issue. It's not how many forms you can fill out. It's not how many times you can make a financial planner send out letters to their customers. I mean, in the end, in that relationship of trust, government's power is in the end quite limited. It's a matter of us understanding the limits of that power and what interventions are actually likely to be effective. I thought that a very, very good analogy was when you have a problem with the door on your house and you call someone to fix the door. The question is, should that person have to do a structural assessment of your entire dwelling mandatorily before they can fix your door? While that's somewhat of an exaggeration, it points to exactly what we are asking of financial planners. How much they have to do, how much is mandated in their practice before they can offer quite simple, targeted advice, often to low-income earners who aren't putting a great deal of money on the table to be managed. So obviously, coming from a very, very different professional background, to understand this field, there's nothing I could do more effectively than to go and spend a day with a financial planner. So Mike Smith in Springwood invited me to his office, and I just spent basically a 6-hour day learning a little bit more about how a financial planner's office works. Now, for all of the descriptive analysis of, from the member for Oxley about how all of this additional burden should be simply carried by the profession, it would be good for him as a Labor MP to simply sit down in the office of financial planner. I was there the day that they were sending out the letters to their clients saying that under Labor's FOFA reforms, we can no longer provide you with any advice whatsoever, and we are terminating that client-advisor relationship because there was simply, under the new rules, no cost-effective means of continuing the relationship. And they were sending out a number of those letters to their clients. That outcome cannot be tolerated because low-income people need to be able to gain that advice without it being too costly to provide. I mean, that is why we're here in this building. We're here in this building to, where we can, as government, secure the future, the financial future of those who vote us to this place. Now, if FOFA goes too far and has that impact, then of course we must do something. And you can see, as I've said at the start of this contribution, that we can argue over relatively small elements, but let us never mix up, on both sides of this chamber, the difference between an association between filling out more forms and a causative reduction in risks like storm capital. And simply piling up the paperwork ain't going to get you there. Certainly you can associate more paperwork with greater scrutiny, but we have to be very, very careful with what we legislate to ensure it achieves the objectives and without the unintended consequences. So the underlying objective of these very important changes, which are widely supported by smaller financial planners who aren't linked to Labor-backed industry funds, is that we need to continue to build the trust and confidence without any more government interference than is needed. And both sides of this chamber agree with the policy intent of FOFA. Let's be honest, it's just about how we get there. And so what we intend to do is to unwind any regulatory overreach, as I've already described. And that's really been created by the current legislation because of effectively an overreaction and a belief in Labor's kind of curious professional wars that they engaged in. And I never quite understood how the Rudd-Gillard government did it, but one day we woke up and eye surgeons, that's right, ophthalmic surgeons were the enemy. And if I can just detain the House for a minute, at some point somewhere someone decided that we had to take on Australia's eye surgeons and halve the cataract rebate because the world would be a better place. And there was absolutely no understanding of the implication that that would have on private sector and private health insurance contributions to people gaining private eye surgery, the increase in out-of-pocket that is created, and then the fall away in people who need eye surgery actually getting it. And of course, we just had this perverse battle between then Health Minister Nicola Roxon and the entire eye surgery sector, until in early 2010, when it was all going pear-shaped for the then Prime Minister Kevin Rudd, we saw Nicola Roxon airlifted out of the red zone, white flags went up, and it was backtracking by the Labor government. And it's this sort of weird professional war that Labor wakes up with in government and decides to embark upon, that this is also somewhat analogous, that suddenly financial planners were in some way the enemy, Deputy Speaker. And I can understand the sensitivities and concerns around the tragedy of Storm Financial, but to sully an entire financial planning sector is the problem that we witnessed under Labor. So I'm happy that the essential provisions of FOFA stay, and there is absolutely no doubt about it, and I'll detail those in a minute. We know that advisors will not be able to receive commission when either general or personal advice is provided, and they'll still be required to act in the best interests of their clients, and there are 6 clearly stipulated criteria in the legislation to ensure that occurs. They'll be providing a warning to their clients if there's any incomplete or inaccurate information, and of course they prioritise their clients' interests ahead of their own, despite what you've heard from the previous speaker. And look, we've supported all of those outcomes from the outset. And we've also announced additional improvements to FOFA that have been agreed with some of the crossbench senators. And these improvements will, among other things, ensure that the essential protections of FOFA are front of mind for clients, as they will be explicitly listed on the statement of advice so that clients can see them. Now, I have to confess that I haven't always read the statements of advice in detail. And for 99% of people going into these arrangements, they probably don't. So please let us never forget the limitations of government intervention in these areas. Just because it's written down doesn't mean the client reads it. Just because the client signed it doesn't mean the client read it. We have an enormous challenge trying to raise the financial literacy of many of the customers and those that visit financial planners. But in the end, we are placing an enormous amount of scrutiny on financial planners in this legislation without the overreach. So, advice continues to be in the best interest. The advice must be appropriate. The advisor will be warning where there are incomplete or inaccurate information, and the prioritisation remains. That's important. But we've also made an election commitment, of course, to amend the law to enable incentive payments which don't conflict with advice that's providing general versions of advice. And look, many have been critical, saying that this would lead to a return to commissions and to conflicted remuneration. But we have to be absolutely clear. We are only removing the overreach and the unintended consequences of FOFA as it currently stands, and never has been or will be the intention to allow the payment of commissions or conflicted remuneration. The rationale for these changes was that individuals who only provide or receive general advice, for example, employees designing websites or providing general information seminars, were at risk under the current legislation and at risk of being affected. And of course, this pushes up significantly the compliance costs that I've already described for small to medium businesses like the one that I visited earlier this year. During the stakeholder consultation, which has been vital on the draft legislation, there were also concerns that the amendments proposed would allow advisors to go back to charging commissions. And those concerns have been listened to, and we've developed a better targeted advice provision. And as such, the final wording of the legislation balances those needs, the needs of the industry, with the government's desiring to see that we clearly indicate that commissions will not be reintroduced. And there's a number of elements within the legislation to ensure that occurs. So both upfront and trail commissions are explicitly banned in relation to general advice. And the personal advice provisions are already obviously ensuring that commissions aren't permitted. And so that's on top of the already existing requirements. The person providing the general advice has to be an employee of the financial product provider and be transparently operating under the name and the trademark and the business name of that provider. That the person did not provide any personal advice other than in relation to a basic banking product or general insurance or consumer credit products to any retail client over the last 12-month period, and that the general advice can only be provided in relation to products issued or sold by the provider or under the name, trademark or business name of that provider. So to put to absolutely beyond doubt how serious we are about not permitting commissions, there will be in place regulation-making powers that I alluded to earlier that may prescribe circumstances in which all or part of a benefit is to be treated as conflicted remuneration. So therefore, if contrary to our clear expectations as a government and our intention not to bring back conflicted remuneration, there are developments in the market that warrant our intervention that can easily be done and very quickly through regulations, although it's very unlikely that that'll be necessary. So are we likely to see a return to commissions paid in relation to general advice? And quite clearly these amendments indicate that benefits paid on general advice cannot be a commission, and that's in the legislation. And this includes both the recurring payments, the trailing commissions, and of course upfront. Is there a risk then that businesses will shift or transition across to only giving general advice simply as a means to push their products? But this is also discouraged in the legislation. The provision, first of all, only employs to employees, so it limits the applicability, and an employee can't utilise the provision if they've provided any form of personal advice in the last 12 months to a retail client. And given the significant upfront and ongoing training costs that advisors incur to skill themselves to provide personal as opposed to general advice, it's really unlikely that an advisor is simply going to step away from that kind of work of providing targeted personal advice and return to a more general advice-only model. So why is the obligation to act in the client's best interest being changed? And I think most layperson focus and a small number of groups have had concern about the changes to this best interest test. And to be clear, 6 of these provisions remain, and they must be articulated today. They effectively prescribe that to act in the best interest of a client, this is what an advisor has to do. They have to identify the subject matter of the advice sought. They have to identify the objectives, the financial situation and the needs of the client that would reasonably be considered as being relevant to the advice sought on a subject matter. And 2, they identify